European Union referendum here in the UK has passed, and as unexpected, of course, we now know that we are, or ultimately will be, out of the European Union. What now? We're talking now to Dhaval Joshi, who is Chief European Strategist at BCA Group. Dhaval, good to talk to you. Thanks indeed for your time this morning. Clearly, it's a busy time for people in the city at the moment. What's your takeaway from what's happened?
Well, I mean, I think everyone's stunned. No one could see this coming. The markets couldn't see it coming because the market started off the night expecting a stay. And you could see that in terms of what sterling was doing, in terms of what other asset classes were doing. And it was only in the early hours that you saw this shift, and even the market was confused because it was really hard to work out what that eventual vote was going to be, because you had all the sort of London counts coming in late and people thought they could make it up, and of course it just went from, you know, one side to the other very quickly in terms of the markets.
But the market reaction hasn't, I don't think, been as dire as some people I've been talking to suggest it was going to be. One of the most high-profile commentators that we had, not on here, but generally, was George Soros. A 20% drop in sterling. That hasn't happened. Could it still happen?
I mean, intraday it did go lower than it is now. I think it went into the low 130s. So you certainly had a substantial move. It broke through 135 and it's now recovered to whatever, 138, 139. For me, it's because I think the worst case scenario hasn't happened, and that for me would have been if...
Hasn't happened yet?
Hasn't happened yet.
Or is now unlikely to happen?
Well, for me, the key issue was the invocation of Article 50 of the Lisbon Treaty, which gets the clock ticking for withdrawal. Until you invoke that article, nothing has really happened, because the referendum has no legal standing, it's advisory, and of course we have to respect the decision. But to actually get the machinery working, you have to trigger Article 50, which the Prime Minister said he was going to do immediately. But what's actually happened is he's come out and said, my position is untenable, I will be handing over to someone within 3 months, and it's really up to the next Prime Minister to trigger Article 50. So we have this 3-month cooling off period.
And in that time, do you think we'll have a chance to step back? And if that step back is taken, one wonders then what the new world would look like.
I don't think that either the Remain campaign or indeed the Leave campaign actually know what would happen in this situation. The Leavers haven't really made clear what it is they want instead of EU membership. And now, now that this outcome has been realised, they need time to think things through and say, what is it that we actually want? Because there's no point invoking Article 50 if you don't know what it is you're going to negotiate for. So is it going to be complete withdrawal and say a sort of WTO type arrangement, or is it going to be something like Norway, where the UK is in the something like the EEA? My own view is that I think it's going to be very, very difficult to have a complete divorce. I think that it's not in either side interest to do that. Yeah. And also there's inherent contradictions I just want to point out with what the Leave campaign were offering, because they said on the one hand we're free marketeers, we believe in free trade, and the removal of red tape, and etc., etc. On the other hand, we're against unrestricted immigration. But if you have free trade, free flow of capital, free flow of goods, tariff-free, that comes with free movement of people. So there are inherent contradictions which have to be resolved on the Leave side, and I think the next few weeks and months are going to see some sort of compromise.
Leading up to this, we already knew that there was some softening of the British economy, and indeed the global economy, I think I'm fair to say as well, because in the States we're not getting as many interest rate rises as had been expected. So there does appear to be a point at which we're now presumably going to see some sort of worsening of economic data, and in the event, Bank of England said it's going to stand by to do whatever it can. Is cutting interest rates an option? Is coming to the market with more money an option? Where do we go? I mean, it's difficult.
I think in terms of do whatever it takes, it would have to be interest rate cuts, which would then obviously feed down the term structure as well. And I think that unlike the euro area or Japan, the UK does have scope to depress the term structure, and that's how monetary policy works, whether it's quantitative easing or rate cuts. Quantitative easing works by lowering the expectation of rates and pulling down long-term bond yields. So there is scope for that. But I think the Bank of England, I think one of the reasons they did nothing immediately was because there is this tension between the fall in currency causing import prices to rise and sort of feeding through, having some sort of inflationary impulse, but the shock to demand working the other way. Which one is going to be the dominant factor which they have to fight? It's unclear at this moment in time. But I would say it would be very, very risky at this point to raise rates to defend the currency when the economy is teetering. Which,
of course, is one of the things that George Osborne was talking about. Finally, just what are you telling clients at the moment? What's the most sensible course of action for those with a portfolio of investments?
I would say, first of all, that the sort of worst case scenario hasn't materialised. I think we've got this sort of 3-month period of uncertainty. But that's also a good thing because, we haven't, nothing's really happened from a legal perspective. So maybe for the assets that have fallen the most, there is a potential sort of entry point. We did have some sort of lower price targets for the major investments, and if you're sort of looking at sort of double-digit percentage falls, you'd be thinking of maybe
it provides opportunity.
Yeah, I think the other thing we can say, and this sort of leads on from your previous point, I think the UK economy is going to slow inevitably because people are going to stop doing things. They're going to hold off a lot of decisions, and that's going to hurt growth. I mean, I'm not sure whether that means a recession, but certainly there's going to be a slowdown in the domestic economy and to a lesser extent in the European economy, because obviously the transmission. So I would look at avoiding the more domestically oriented stocks and sticking to the multinationals. So it's more of a sort of a relative trade, maybe sort of prefer the FTSE 100 versus the 250, or FTSE 100 and sort of underweighting retailers maybe, or home builders.
What about the banks? Banks taking a very big hit today. Where do banks stand in all this?
Well, from an investment perspective, they are high beta. They had vulnerabilities anyway across Europe because credit growth is weak across Europe. I don't think this is going to strengthen it by any means. This is going to add to worries, add to uncertainties. I think credit growth will remain lackluster. But apart from that, you've got other headwinds, regulatory headwinds. The fact that you're taking on greater risk because you're higher up the pecking order when a bank fails as an equity holder or even a bond holder now. And of course, the net interest rate margin is very low because of because the term structure is so flat, and you can't go more negative anyway now because because you're at the limit. So the banks short term will just be a high beta version of the market. If the market rallies, the banks are going to rally more, and vice versa. But structurally, I'd still be pretty cautious.
Let's hope we don't get any bank failures. I think that's obviously one of the worst case scenarios.
Absolutely.
Dhaval, look, thanks indeed for joining us. Dhaval Joshi there from BCA Research.